Hey, good morning. Good morning. How's everybody doing on this fine day? All right, we need to go through and look at our portfolio, and then we need to see if there's not some opportunities for us to put on some bull call spreads with a naked leg. Why have I decided to put on bull call spreads with a naked leg? Well, because a lot of what we do in this class is talk about our UBI, our Universal Basic Income Portfolio, and that's been a little bit of a focus for us these last little whiles. And so the bulk call spread with the naked leg is kind of the shorthand of what these yield max funds that we like to trade do. All right. And so I think it's important for you to understand what they do so you can be mindful of what your money's being invested in if you're trading in these UBI portfolios. All right. So I think it'd be fun to go through and put some bull call spreads with naked legs on them, just so you can kind of get an idea of what's happening, and then you can do it yourself if you want and learn what they're doing and do it yourself. And it's a good strategy. All right. So the first thing I need to do is we need to go through and we need to look at our losers. I like to start out with a nice big winner. I mean, we're looking at AMD right now, and it's still taking off, and we're up 11 grand on this one, and so we're happy about that one. And that's an easy one to look at and say, oh, we're doing great. Oh, isn't that nice? Oh, wonderful. Oh, aren't we great? Aren't we wonderful traders? Oh, we know what we're doing. And then you come down and you look at a couple of the losers like Salesforce, which is a real disappointment to me because it was a perfect setup. And then Bristol Myers, of course, we know that, and was just one of these stupid things we did. And we've been selling calls against it to collect a premium to help us cover the downside. And we've done pretty well on that. Now, stupid market. Look at this stupid thing. It came down and now I don't know what to do about this. I guess we just keep selling calls. But right now, there's the low and there's the high, and it's coming back here and it's touching 61.8 right on a train on rails. All right. It's right there at 61.8. Now, why do markets bounce at these numbers? Why do they start to go back up at 38.2, 50, and 61.8? Why does the market come down off these peaks and start to go up at these levels? Well, these are very common, popular levels for traders to be putting their orders at. And it's also very common, very popular levels for people to be putting their not people, but for the algorithms to be putting their orders. All right, a lot of algorithmic trading starts to buy there, so there's a lot of orders put at these levels. So that's also what draws the market down. If you think a whole bunch of orders sitting at a price, it almost acts like a magnet. So it pulls the market down so the market can fill those orders. Because remember, the market is like a big machine. All right, it makes money. There are groups of organizations, big companies that make money by filling orders, right? They're the market makers. And so their job is to fill orders. And now they can't push the market around too much, but they have a little bit of pull, a lot of bit of pull. All right. They can push the markets around a little bit. And if they see a big whole bunch of orders sitting at a certain level, they'll let the market go to that level because they want to fill those orders. Now, retail traders are the ones that get seen like that. A lot of the big firms, BlackRock, Vanguard, State Street, these big companies that run these big Aladdin mathematical models that run these quant systems, for the most part, you can't see their orders. All right, they're hidden. So those orders are not going to be seen. But a lot of retail traders will put their orders at the same place as all these big quant systems. And the quant systems put their orders in here at 38.50 and 61.8. So as a market gets pulled down to those levels, that's why we oftentimes say, well, markets will come back into what I call the Fibonacci sweet spot, which is right in here, right? And the reason it does that is it's being pulled down there to fill those orders that are sitting there. And then the reason the market rebounds and starts to go back up at those levels is because the orders are filled and lots of buyers buy at 61.8, and that rallies the market, right? So you get a lot of buyers and that rallies the market at 61.8. So that's why we get those reversals. Now, I want to talk to you a little bit about the Delta Kona probability while we're here, because the Delta Kona probability is what the Fibonacci ruler is. So calculating the delta Kona probability, also known as the 68, 95, 99.7 empirical data distribution rule, approximately 68.2% of the time, markets stay within the one standard deviation. Now, there's a lot of different tools that'll measure standard deviation. There's probably the most popular is the Bollinger Bands. All right. So if you like Bollinger Bands, that's what you're doing. You're measuring the one standard deviation. So the market likes to stay within that one standard deviation 68.2% of the time. Now, around 95.4% of the time, it falls within two standard deviations. So that's why markets go through what we call the ABCD or the ABC levels, the ABC patterns, right? They go up, they pull back. That's the one standard deviation. Then it'll go up and it'll pull back. That's the second standard deviation. But it will, through the smaller point, it's returning back to the one standard deviation of the second standard deviation. That's why we have the A drive and the B drive. And then that nearly 99.7% of the time, it falls within the three standard deviations. When it makes the C drive, that's the third standard deviation. So the market is going through those three standard deviations, and on each run, it goes up and back, up and back, up and back. That's what makes a market go through waves, right? 2 steps forward, 1 step back, 2 steps forward, 1 step back, 2 steps forward, 1 step back. We generally anticipate a 3-drive pattern when that happens. Now, there's other, extenuating circumstances that can cause a market not to do that. Like maybe, I don't know, war. Okay. So people get scared around war and think that we're not going to have good economies. Market's not going to go up. They get scared. They start to sell out. Markets start to not perform and behave the way that a normal person might perform and behave. In a normal market. And when have we had normal markets lately? We don't have a lot of normal markets. And then you'd be surprised. You go back and look, and the markets still perform in these 1, 2, 3, and standard deviations. So it's kind of an interesting game that we're playing here. And we're constantly looking for mathematical modeling of the market. That's what we do. All right. We try to reverse engineer the mathematical model side of the market to determine where we're going to buy and sell. So Bristol Myers right now is hitting 61.8. Is it a buy signal for us? Yeah, it probably is. But do we want to? Yeah, I don't know. What a piece of shit market this thing's been for us. It's not really been good. No, I mean, it's only because we kind of did a stupid thing and bought right here and then didn't sell it. All right. So the market's coming down. It's made this nice little head and shoulders formation. It's gone up. It started to rally. It come and touched this previous high, right? Just like, again, what? A train on rails. Came up and touched that previous high, and it fell, and it's coming back down, and it's touching the nice little 61.8. Does that mean it's going to bounce right there and go back up? Nobody knows, right? We don't know. It's just probabilities. The probabilities say, yes, it's going to bounce and go back up. So if that's what the probabilities say we're going to do, well, we should probably put an order on there. Okay. Although it's trying to save a dying market. I mean, this dumb thing is just really not even turned around and started to rally with us very strongly. But we have sold a bunch of covered calls up here, and we're actually where it says we're down 2,500. We're actually only down about 1,500 because we've sold $1,000 worth of covered calls. So if you'll notice though, that this thing only has 57 days left. It's gone. We're not going to really get anything else out of it. In fact, I don't think there's anything left in it, is there? Yeah, $187 is all that's left in it. We're going to lose all that money. So we might as well just take it. All right. So we're going to liquidate that today. Take our $187 because we're never going to get anything better out of that. And it's pending the close. I don't know. Let's see if we can take it off a little faster. Liquidate option. I did a market order, so it should go in. Let's limit this thing in. We're going to sell at 58. We'll see how fast we can get that off of there. Come on. Get off of there. How many? Let's see. The options chains. Let's go see. What's the volume on this thing today? We got this thing. It's probably got no volume on it. So they're not going to let us out. It's the 52.50 on, how many days left? 57. You know what we could do? They're not going to let us out. 57. Well, it's got plenty of volume. Why in the heck are they not letting us out of that? I got a better idea. Let's cancel that. And let's just come in. Come on. Now they're not letting me off of that. Come on. What's going on here? All right, let's go in instead of selling it out. Let's just go in and use it as a, let's come in here and see if we can, we've got 57 days. Let's come in and sell. Instead of selling it, well, we're going to sell a call. It's going to let us have any money on. Oh, it's not going to let us have any money at all. There's nothing we can really do with it. We just don't want to get out of it. I thought maybe we could collect some premium against it, but it's so far out, there's not really anything we can do. We're better off just selling it. Okay, let's liquidate, see if we can get rid of it one more time. 67, it's not that way. I know it's not that way. It's got to go the other way. Liquidate. Come on, why are you not letting me out of this thing? We'll just let it sit there and pend for a minute. I don't know why it's not letting us out. All right, we could come in and buy one again here. Let's put on a bull call spread with a naked leg. Should we do that? All right. So we're going to come in. This thing's causing stress for me right now. The stupid market won't close that position. All right, we're going to do a bull call spread with a naked leg. So we're going to come in here and we're going to go out and we're going to probably do it at the same, let's do it at the 30-day mark. Let's go see what we've got down here at the 30-day mark. So center that. We're going to do, well, we got a well, we're going to have to come up here and do it at the, we got 1,000 open interest. I like 10,000 open interest. I like to have that be at least 1,000 and 100, and we've only got 60. Let's try it and see if we can get it on there. It's not letting me fill any orders. So let's come in here. And a bull call spread with a naked leg, we could probably just come right in here to the little calculator and bull call spread right there. See that? We could just put it on like that. But I don't like to come in and do it that way because that doesn't teach you anything. It doesn't teach you how to put on a bull call spread. So we can do it. Just come in here and say bull call spread. We can drop it in there. And you can see it puts it and fills it all in there. So you're going to sell a call and you're going to buy a call, and it's going to drop it in right at the money. That's a bull call spread right there. Very simple, very easy, but that doesn't teach you anything by using the calculator to just do it for you. So let's go in and talk about why we're going to do what it is that we're going to do. We're going to do it manually. That stupid thing is still pending. Let's come back and we'll do it when that thing's closed out. I want that thing off my books, and then we'll put a new one on. Let's go just look at something else first. Let's go look at AMD. We're making money on AMD. We should have put another option on right here, huh? Yeah, but we didn't. How many did we have? We have 5. And the reason we bought 5 is because we were going to sell, and we got 274 days. We were going to sell calls against this, but the market kept going so strong. I think we sold some calls right in here. Maybe we did some, did we? I didn't track it very good. You need your spreadsheet and you need to track these. But we could have put, I think we put sold some positions up in here as this market started to peak out. We put in some, was it this market that we put on some vertical spreads, and we took some profit off up there. But that's the whole reason we got into this market. 274 days, we're going to do a poor man's covered call on this, and we're going to sell premium against it. But the problem is, not really a problem, the market's been rallying so strong, we haven't been wanting to cap our profits, right? Because if you sell premium above the market, it caps your profits, which is, you know, you're taking profits, so it's not that bad, but you don't know. You don't know whether it's going to take off and go more than what you'd make if you capped your profits with your sold calls. And that's what YieldMax does. They come in and they sell premium against it, and they don't care if it caps the profit. They're going to take the profit that they get, and that's what you get. All right, and there's nothing wrong with taking profits. So they come in and systematically sell calls against the market like this, and see that's going to receive $165, and that's how you make money. That's how you make dividends in YieldMax. So there's your dividend right there. See, $165 is what you'd receive. And you're like, well, why would you do that? It's capping your profits. Anything above that number, you don't make anything up in here. Well, they're willing to take that risk. They don't think the market's going to go up in there. So, or if it does, they don't care. So it would have to go up in there by $165, which isn't really all that much. So that's why we, as in this little portfolio, haven't been doing it. We haven't been putting on our bull call spreads. We haven't been putting on our capped portfolio profit capping sold calls because the market's been going so strong up. Why would we put on the cap, right? So we could just leave that off. Better off right now just doing a little count and measure here and deciding what this market's count at. So if we come in here and we say, well, we're going to say this is our A1 down in here, and this here is our B1, right? So we're in the B drive. So the A drive was back, there's the blue lights. It's probably, technically speaking, it's back in here, but we're just going to say right there. And then this in here, we're going to say right here, this is the B1, right, where it breaks those blue lights, okay? Now, this stupid thing did that exact same thing that it does all the time, which makes it confusing. It goes up and you're like, well, Lan, is this down here B1? Is this B1 or is this B1? I don't know. It's B1 somewhere in there. And this could be B2. I guess you could call this B2. All right. B2. I don't know. It could still be part of B1. You never know. Yeah, you don't know, but it doesn't really matter. It's just a little pullback. It's a pennant formation and it's a buying opportunity. And it's close to the bottom. It's down in here. It's either B1, B2. We find out later. We'll find out later. All right. Hindsight's always 2020. Stop doing that auto scroll thing. Damn it. Okay, so now what we're going to do is we're looking for an opportunity to take a long position in here. And unfortunately, we've missed it because we weren't paying attention. So the opportunity was either one, it was right in here, when it broke this, but we thought maybe it'd come back a little farther to 38.2, or 50%, we might get an opportunity in there. And then when it broke the blue lights and it broke down in there, that was another opportunity to maybe put on another long call, but we didn't. And so we're sitting here going, should we put one on here? The answer is no, not right now. And the reason is because the market's rallying and we got a situation where implied volatility is going to be going against us, or delta is going against us. All right. So you're going to look and see, oh, well, actually, I was going to say, look at the theoretical value. The theoretical value tells us that the option is worth $924. That's at a 29-day option. If we wanted to do that one here, we probably want to do a little higher, long 20. It's telling us that the option is worth $1,887 and we can buy it for $1,470. That's not bad. That's not bad. We are at a B2. That's not bad. You can buy it for $400 less than what it's worth. I'd like to buy on a down bar, not an up bar, because then it would even be a greater discount for us. Implied volatility. Delta would be going in our favor, not against us. There's 5,000 of these being open interest and 100 of them have changed hands today. I'd rather buy this one right here. 1740, it's worth 2,000. That says it's not a bad buy. If you were to buy a car that was worth $2,150 for $1,740, you wouldn't feel bad about that. You'd feel like you got it for a good price. The reason that people are buying that, saying that that's a good price, though, is because they don't think the market's going to continue higher. But we do, don't we? We believe in our system of ABCs. B2 is not a bad place to buy, and that might even just, I know this got to be A1, and B1 is down here. It's in the valley before the blue light. The blue light is actually the break. That's the B1. You can get it earlier. You can call it down here, but the B1 is the break. The blue light is the break. It's the B1. So this little pullback here, just because it broke right there on the blue light and immediately fluffed, it's all B1. But that, technically speaking, it is what it is. That's B2. So you can't cheat it. And it's already rallied 3 bars, and usually the 4th bar is the one that pulls back. I don't know. Let's go ahead and mark it into it. See if it'll let us have it. No, nothing's filling. I don't know what's wrong with this. Let's go back to Bristol Myers. Have they let us fill it? No, that one's not filled either. They're not filling our orders. I don't know why. Nothing fills. Let's come in here and edit. We're going to go in with a We'll limit order at a buy. They're asking 17.50. We're offering 17. Let's offer 17.55, more than what they're asking. And it still won't fill. So I don't know what's going on. I don't know why they're not filling any orders. Not filling any of our orders. Let's come through and go and look at another one. Let's come into Salesforce. Salesforce is a little disappointment to me. Can you imagine why? Well, because this market was coming in and it was going up beautifully, right? And it came down, right down into our Fibonacci sweet spot, just like we expected. Everything did just what we expected. Look, it even came down, hit the 61.8, just like a train on rails. Turned and started to go back up. Dipped right here perfectly, went and looked like it hit the blue lights, getting ready to break and go higher once again, right? But that's not what happened. This thing dipped one more time. I don't know why. Why would you guys not believe in this market? Look, it's a down day today. We got the blue lights coming in underneath there, and that's not a good sign, because if that breaks the blue lights, which it looks like it did, we'll find out tomorrow. That'll put a blue light up there, and that is bearish. And we've got, of course, this big bearish thing here going on. And this is going down too. This is not good for Salesforce. It's also not good for us. That looks like it wants to continue down right now. And we got a nice long 274-day long position on it right here. We were feeling pretty smart. We were feeling pretty smart right there with our long call. We even had some long shares in here that are now underwater too. Okay, we're going to kill the shares. The regular market is currently closed. Is that what's today's Thursday? Why is the market closed? Is today a holiday that I am not aware of? Oh, Randy saying today's Juneteenth. I didn't know they closed the market on Juneteenth. No wonder the markets nothing will feel. I didn't know it was a holiday. I'd have taken it off. What are we doing out here trying to trade on a holiday? I didn't know it was a holiday. How did that slip by me? I remember that happened last year too. Last year the market closed on Juneteenth, and I was like, why in the hell is the market closed? We never close on Juneteenth. Well, I think Biden made that, right? Said Juneteenth is now a national holiday. So many damn national holidays. Always closing the markets. I don't want the markets to close. Turn those machines back on. Well, that doesn't make it any fun. That doesn't make it any fun at all. Well, Frosty, good morning, but the markets are closed. Hey, I like your little graphic there. That's pretty awesome. Are you bond? 2-year bond? Right, straight out of Pitt News magazine. Well, I guess we can still go look at the markets and anticipate what we're going to do tomorrow. Because tomorrow's Friday, and I guess the markets will be back open. And I don't know. We need to watch Salesforce for sure. Can't put on a bull call spread. It's not letting us put anything on today when markets are closed. No wonder nothing's working. Wow. Well, let's run down through the charts anyway. We're all here. We're all ready to learn. So let's keep learning. Can't place orders, but we can at least do a little analysis, right? You know what we can do is we can go look at our portfolio. I got to show you. I made some math errors. My math was wrong on my spreadsheet, and so I had to make some changes to that. And I updated the spreadsheet, the one that's out with Pitt News Magazine, so you guys can have that updated spreadsheet. I know every time I give you a new updated spreadsheet, you have to copy all of your orders off of your old one onto your new one, or you can just make the changes. I'll just show you what the changes are. You can just make them. You don't have to copy and paste everything into the new spreadsheet. Oh, I'm a little disappointed that we're here trying to trade and the markets are closed. Figuring out what we're trying to do. Let's go look at Cisco. Cisco, look, we're happy about Cisco. We got our vertical spread up here, and we're going to make money on that one because, well, holiday. We got one extra day of free money. Let's go positions chart only. So we're up $562 on our vertical. Oh no, this is our vertical spread. We're up $105. What's the maximum we can make? Probably about $105. Maximum we can make. Oh yeah, we're at max profit. 141, 60, 50. Yeah, we're at max profit on that one. If we were here, I would just close it out. But no, we'll just let it go because it's going to give us max profit. There's no way it's going to be a close. Well, don't say no way. It could happen. That market could shoot up and close above the red line tomorrow. That's what it would have to do. Chances of it doing is pretty low, but it could do it. And then we'd lose everything. But what is this? $105. $105 better than a kick in the teeth, right? We thought maybe we'd get a little bit better pullback in here down into the Fibonacci sweet spot, but that never happened. So Cisco's a nice, strong market. So we should probably be looking on an opportunity to take another long position right here. What we would do is come in here, and if it wasn't a holiday, we'd come down, look at the 120 and buy a call right in there. See where we could get a call. We could probably get one, looks like about $400. I think that would be worth it. We could put that in there, come in here. We'll just go ahead and place our order, mark it into that. Maybe it'll fill it tomorrow. All right, so we're going to put one more in there and take a long position up out of this B1 because this is a B1. So down in here, that's the X2S A1 to the downside, right? A1. This is a B1 right here. So this is B1. We're going into the B drive, second drive. We like B1s. B drives are usually the good drive. And look, it did that same thing. It broke the blue light and then pulled back down into this little trough here. So B1, B2, maybe. I don't know. It'll tell us, we'll probably know in a couple weeks. So we can adjust these. We're going to call this a B2 for now. We don't know. We're going to call that a B2. I like to see it rally a little harder past the blue lights. But that's not, you notice that that's so common for it to do that. Break the blue lights, and then immediately pull back, and then start to rally again. So maybe that's a good thing for us to keep in mind, because that'd be a good buying opportunity. Breaks those blue lights, and then immediately pulls back. That's where we want to be a buyer. So we can buy right in there, right? In anticipation of the next rally. It's still above the lower blue lights. So our trend is actually, our natural trend line right now is sitting down in here. Remember, this is the mathematical trend line. All right. And then of course you got the horizontal trend line. That's your little spider web going to the downside. But we're not going to the downside. We're going to the upside. We think this market's going to continue to rally up. All right. So, and it never did come down into the Fibonacci sweet spot. So we just have to throw that one out. It's like, well, land, it didn't come down in the Fibonacci sweet spot. Do you have to wait for it to come down there? No, it broke the blue light. It's done. Stick a fork in it. All right, now we go off to the next one. So we can make an anticipation if the last one was this big. So we say, well, that's how big the last one was. We can come in here and say, well, if the market does the same thing, we put that there. If it's a reflection, you can make a Fibonacci projection, right? So a Fibonacci projection would anticipate that we should see the markets up into this same region up in here somewhere, in the same amount of time. You can project the Fibonacci time zones as well. See, have you ever used the time zones? You watch this, you got a Fibonacci time zone. It goes like that. So this time zone took, this one took 34 days. So we'd come in here and we can put that over the top there. And then you would anticipate if it did the same thing as it did before, we'd be up into this region up in here. So that's your Fibonacci projection. Now that would be a pretty aggressive market if it did that. If that second drive was that rally. And I think we can actually I can't remember if the software does this. Let's look and see. I think you can turn. You go into the Fibonacci ruler, right click on it, and turn on the Fibonacci time zone. So there they are right there. See that? So you don't have to even draw the Fibonacci time zone as a separate tool and lay it over. You can just right click on it, turn it on right there. So this becomes what we call our time zones, right? Time zones are in between. So each one of these is a time zone. But then these are your time slots. All right. So your little projections come in on these. And you just look at the previous one and see where it went, and then you anticipate that one. Now, what I like to do is when I do Fibonacci projections, I'm going to turn this off. I'm going to show you something really cool. Happens a lot too. All right. If I could get it to delete. Delete, deleted, deleted. Why won't it delete when I hit the delete key? Delete. There we go. All right. So now I take that Fibonacci time zone, which is all by itself, and I run it backwards. And I do this. And then I look for and try and anticipate where this thing might be going based on forward and backward time projections. So then we can put this on the low of this point, 89 days, like this. And is this voodoo science? Absolutely. This is voodoo science. And we're going to come in here and we're going to draw that up there. But voodoo science works sometimes. Just ask my little voodoo dolls. Voodoo science. All right. So this is mathematical modeling from a Fibonacci time zone. All right. Now, again, I was taught this at the Chicago Board of Trade. So whether these guys actually work this into their mathematical models, it's to be determined. It wasn't exactly the most popular thing we learned there, but it was definitely one of the things that was taught there. That's why it's in my software. Almost everything that you see in this software is because I was taught it at the Chicago Board of Trade, because that's what I did. I went to the Chicago Board of Trade, and then I would run back to the programmers and tell them to put the features in that I just learned at the Chicago Board of Trade. So that's what the software is. All right. So this was actually a tool that they taught me there. And there's a lot of time slices and time cycles and all kinds of stuff that we learned. That's why we have all this timing stuff in here of how many days markets have a tendency to move. So there's a big section that we learned on time slices. Of course, they do all kinds of funny things back there. They look at moon phases. So moon phases is part of something they do at the Chicago Board of Trade. They look at moon phases, and you're going to be surprised. Now, I never put moon phases into my software, because I thought, well, that's a little crazy. But so I never put moon phases in my software. But it doesn't mean it doesn't work. It's just something that you line up, and I don't know if it's coincidence or what, but moon phases, markets have a tendency to turn on moon phases. So just for fun, since we're talking about moon phases and the markets are closed, let's go look at the moon phase. Moon phases. So we can go look at the images, and you get these little moon phases, right? So this is, well, we're not going to spend too much time on it, but you can go look at the moon phases, and the moon phases are telling you when it's a full moon that markets have a tendency to turn at full moons. So we can go and find out what the moon phase is today. There's a little app on your phone you can put on there, and every now and again I'll take a look at it and see what the phase of the moon is. Just because they taught it to me at the Board of Trade, right? I learned it there, and then we can look and see where the moons are, and it's just fun. All right, so I left it out of the software. Sorry, it's not in there. I didn't have enough faith in it to believe that was something. But the Fibonacci time zones, they are, right? Fibonacci time zones are something that they work pretty well. So this tells us, this is kind of, I run this backwards and I find these big spots back here. Now, of course, you have to see that. So 89 is the low here. And then the Fibonacci sequence broke right here on the 55. Look at that, almost to the day, within one day. So see how that went from here to here? It went from 89 to 55, which is a Fibonacci time zone. And that's how big that move was, right? Within, I mean, it's just uncanny, right? I know it's voodoo, but sometimes voodoo works. So if you take that and go out, the next one is at 21. That's why we said we figured that the market would be out in this region right in here somewhere, because that's what it did last time, right? So up in here. Now, it's also got this countdown timer. See, I like to run it this way. We line this up with a previous low in the market, and then we look at where these Fibonacci time zones are, and these are important, generally turning points in the market through time, through price and time, right? That's why we always talk about price and time. So as we come out to 21, we're going to look for that to be a peak somewhere out in here. That's going to be we're going to anticipate that being the high of this next rally. Whether it's down here, up here, that's to be seen. But then you have this other countdown out here. Now you can, of course, obviously you can move your time zones over here, and then the time zone would be here. And again, hindsight's 2020. But you can take this tool and go back in time and look at it, and it doesn't work every time, but it works so often that you're almost like, damn, why am I not using that tool all the time? So you come out here and you can see this little countdown timer out here. And so what happens is we would anticipate maybe something like this, and that would be the top of the market, right? Out here, the little countdown timer. And as it gets closer and closer and closer to zero, we would anticipate that being right up in here somewhere. This is going to be the top of the market. Now, how far the projection is going to be, you use your Fibonacci projection tool. You come in here and you would project where that little pullback, that rally and the pullback up to here. And then you'd say like this, and you take the next leg, you go from here to here to here, and it gives you that projection. And look at that. If that was how that worked out, that would turn out that our projection, 9100, would be right there, right at the end of the Fibonacci time zone. So that will be an important time for us up in this region, up in here for this market. And if that's the case, we'd want to be done with this market for now. I mean, at that point, the odds of us making any money on that market going any higher is pretty low. So we stick a fork in it and sit on the sidelines with Cisco. So that's how that Fibonacci time zone works. If you've seen that in the software and you're like, oh, how in the heck, how do I use that? That's how you use it. And again, I didn't make it up. I learned it at the Board of Trade. That's why it's in the software. All right, that's how that works. Let's go look at, so what are we going to do with this one? We can't buy anything because, well, we got this order here. Is that our order that we're buying? 120 days? It is. Oh, we are. We do have an order in there to buy tomorrow. This one's going to expire, so we're good with Cisco. Let's go look at NTRA. Now we're happy with this one, right? Okay, so we come in here. This is our one. I'm going to call that. That's got kind of a funny little top on it. I'm going to call that our X2SA1. And we can call it X2SA1 with a little bit of confidence because the other markets made X2SA1s, all right? And they were more obvious. So if sometimes you have to look at other markets and say, well, this market's traveling, all the markets are kind of doing basically the same thing, right? So if they're all making very clean X2SA1s and this one's a little dirty, you can just say, well, it's probably the same. So X2SA1, and then this is our B1 right here. So we got X2SA1. Let's just count them for fun. So this is X. This is just an A2 right there. This is an A3 right here. So that's A3. This is A2. And then that's it, the end. And it came back down in here, started a rally. And of course, that's where your spider web comes in, if I can find it. So you go from here, your natural trend line come down and broke here. I'm gonna kind of, you got kind of one there and you got kind of one there, don't you? Kind of two little natural trend lines. Then you got your mathematical trend line, and then you got your horizontal. So there's your spider web, just like that. And we're starting to break above the previous high. All right. So right there, a lot of people like to buy and break above a previous high, but look at all those faults, all those hairy tops. Right? Fuzzy tops, as Claire calls them. Look at all the fuzzy tops. But it finally broke. Today it looked, well, yesterday, it looks like that market finally decided it wanted to go. So we're in here down off of this low point down in here where the market pulled back. Now, I don't think this one, looking at it, eyeballing it, Doesn't look like it ever came back down into the Fibonacci. Well, it did. It came down into the Fibonacci sweet spot right here with its fuzzy bottoms, but it didn't ever come down to 61.8. I mean, it kind of dipped down in there, but it never had a close below 38.2. It just rode right across 38.2, which is very common. 38.2, oftentimes market just pulled back to 38.2. That's a good buy spot. And we waited. It kind of took off, and we waited. But we're in there with 20 shares, and we're up $265. We could put some more shares in, dollar cost average in. We got a little stop order right in here. We set underneath that little shelf, and it's starting to take off. So that's good. We could move our stop if we wanted to tomorrow, but we'll just leave it for there. And we might actually dollar cost average in. I think we could dollar cost average in and feel confident bringing our order up to underneath this, at least to where our stop's at. So we'll watch that one too. Natera, that's the one that's going for us. All right, and of course we got these high points up in here we need to look at, right? So up in here, this is where we got some points up in there that we got to be mindful of. Of course, that's why that yellow line's there. I just turned on just because I'm lazy and don't like to draw lines all the time. I just have I have the Donchian channel turned on at setting of 100. So that's setting there at 100. That's not the default. If you go to T&T default, that's something like 20 or something. I don't know, but I put it at 100. It helps me see where the Fibonacci sweet spot is, or the Fibonacci ruler is at these highs and lows of these peaks. So that's why I use that. It's just kind of a little guideline. You can turn it off if it's in the way. Draw your Fibonacci rulers in there. But that's how that's going right in there. That's RA1, and this is, of course, B1 right here. You got the break of the blue light, so that's B1 right there. And then we got the fuzzy tops. So we're going to call that B1 right there. And then this, ugly as it is a B2 right there. So there's your B2, and it's breaking out on the B2. That's why I say we could add some in on B2. I don't feel bad putting money in on B2s. I won't put money in on B3s. Well, you might add a little on B3, but you're not going to get in fresh and new on a B3. You can get in fresh and new on a B2. Usually you don't want to, though. You want to get in on the B1 and then add into your positions on B2. And you can add in a little bit on B3 as you anticipate that last little push higher, but then be ready to take your profits off. All right. And if you're going to hang on to a little bit of them, then take most of your profits off and leave maybe 10% on. So when it dips, you don't lose a whole bunch. Take some of your profits and let that last 10% dip, just in case it really does take off on that B3, which is rare. All right. You want to use a Fibonacci time zone on this one just for fun? Turn off that auto scale. It keeps screwing things up. All right, and we come in here. We're going to go backwards on it. We got to go backwards on it. So we're going to go backwards, and it goes all the way back here, and that gets a little too far. So I don't go back to the 144s. You can just for fun see if it lines up with anything. But we like that 89, and we start with 89, and we put that 89 on the very low right here. All right, now look, the 144, pretty close to that peak right there, pretty close to that valley right there. I don't know. It's right there. But we're going to not pay attention to that. We're just going to go off of this one. But Lan, what about the one previous to it? Well, you don't know. You look and see where things line up a little better because you got some history that you can go off of. So you got your first rally, and then you're down it kind of right in there, kind of right where the B1 starts. So that's almost as one full miniature Darvas box, isn't it? It's the 3-drive Darvas box right there on the mini Darvas box. Usually the Darvas box we count as the entire 3-drive pattern, but everything's fractal, right? Everything's fractal. So you can have that be that's the one little Darvas box right there, and it's right perfectly timed, almost timed within that perfect little Fibonacci sequence right there. So then we go over, we raise this up, and where do we think that's going to go? Well, 34.34 is going to be an important number. And so we may get our B3 right there. This could rally up for the next few days, maybe up into here, and then we get another little pullback. This may be where we get our B3, and then we get going up into maybe B2. I don't know. Just, spitball it. And then maybe you get the C drive, and then you get another push up higher out into there. I don't know how it's going to play out, but that's kind of plays out through those, and then that ends up being the end right there. We're done. Stick a fork in it, and then anticipate the full drop. And then this would be the full Darvas box right here. That would be your full Darvas box. So you'd have 3 drives. You'd have your A drive, you'd have your B drive, and then we have our C drive. And that's what that Fibonacci time zone is supposed to be measuring. All right. It's measuring the size of your entire 3-drive pattern. And I like to start it at 89. Doesn't mean it can't go out and push this out a little farther, but I like 89. 89 seems to be the good starting point for your first lowest point, and then anticipate the 3-drive pattern through there. Now, it'll adjust based on whether the market's got bigger patterns or smaller patterns, right? Because you'll put that in there and you can adjust it. But usually that's the pattern. It sticks right within that 89 time zone pattern. So it's pretty cool. It's just the way it works. Whether it's right or accurate, it's pretty close most of the times. I mean, it's pretty close. That's why it's there. It's because it works. Why does it work, Lan? I don't know. It works probably because it's all based on fear and greed, the psychology of markets. That's what all of this is. These A2s, A3s, B1s, B2s, all on the psychology of markets, based on the psychology of whether we can get the retail traders to buy out our positions in these zones and where we want to buy in and reaccumulate and accumulate and distribute and be done with the market and take our profits and start it all over again. It's all having to do with the big, huge quant systems on where they're going to do their accumulation distribution, right? And all we're trying to do is reverse engineer and model it out. So NVIDIA, oh my goodness, let's clear out everything. Let's just start over with this one. Look at this market. Wow. Wow, 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 wow. How many of you have some NVIDIA? I do. I have some NVIDIA. I have it in NVDY though. How much do we have in NVDY? Should we pull it up and look? I'm curious. And while I'm here, I can also show you my spreadsheet, show you where my mathematical model was wrong. All right, so here's my real money UBI spreadsheet. And this was where I was wrong. I was calculating the cash cow and the gravy trains wrong. So yesterday, was it yesterday we were talking about this? And I was like, look, it shows that my account is a cash cow. My whole account, this is the whole account calculations up here. And I was like, look, my whole account is a cash cow. That was a positive number. And then I was like, well, that can't be possible. That's not true. How can that be a cash cow? I'm starting with 476,000 and I've made 289,000. That's not a cash cow. So I looked and I was like, oh, that doesn't make sense. You can't be a cash cow if you haven't made enough money in your profits to cover your initials. So I had a math error and I went and I fixed it. And then I have 2 numbers. I have a cash cow and what I call the gravy train. All right. So this one is how much have you made? Well, you've made 289,000 since you started with your 476,000, which is back in July. So in this past year, this little account has made $289,000. I'm happy with that. That's not bad wages for 1 year. I couldn't work at the gas station and make that. And so I'm doing better than the gas station. And that's my goal. Make more money trading the markets than I make working at the gas station. Because if I had to stop trading, that's the only skill I got. I ain't got no other skills. All right. I would have to go back and work at the gas station. Not that that's a bad thing. My dad ran 5 gas stations and worked there for many years, many, many years. All right. Hide that. All right. So that is saying that I've got 5 more months at this level. If the market continues to give me my income at the level it's been giving me for the last 11 months, it'll take me 5 more months to get to be a cash cow, my full account. Now, the question is, I don't know if I'm doing these right. I think I'm doing these based on, they have to be based on, these cash cows have to be calculated based on total infusion. because they're blended money. And blended money and separate money are two separate things. So if you start your account and you don't start it with a bunch of blended money, which I did, which confuses the spreadsheet. Because if you got all this blended money, meaning let's say you put in 100,000 and then you start your account with 476,000, well, you got about six, if you know it was 100,000. I don't know what I started it with, and I guess I could go back in history and try and figure it out. But that's how I figured out 476,000, because I asked ChatGPT. I gave ChatGPT the history of my entire account, and it says, well, you started putting all this money in to these YieldMax funds around July of last year, and you put in about 476,000 at that point. So I was like, well, let's just go with that number. So you have to pick a point somewhere along the line. And my money is all blended money. And so I said, well, my initial money is 476, even though it's blended money. We pretend like it's not blended money. So my initial investment is 476, but my total infusion is 830. See that? So I've received 227,000 in dividends. I've got a total infusion of 830. So if you add 476 and 227, that's not quite 830. I have a dividend reinvestment of 353, which means that I've also made money somewhere else. I've either added more money, which should have been put into initial deposit, but probably wasn't. And so I ended up with, and I also traded stocks and options. So I made $22,000 in my stock and options, right? So I have that stuff that we've been trading, doing the bull call spreads, doing the long calls, doing all that kind of stuff, right? So we make money that way in this account as well. So we take some of the dividends and not just reinvest them back in, we go and trade them somewhere else. So we made $22,000 in the last year in this little account doing that. And then I pulled out $90,000 and gone and spent it. All right. And I've used that money to develop a software program, so I don't need the spreadsheet. We're still working on it. It's beautiful, guys. I'm telling you, it's really pretty. It's called Portfolio Matrix, and my son's the primary programmer on there, and he's working on it. But we've been working on it hard together. And of course, I'm basically the financier, so angel investor, and so that's what we've been doing. We've been spending money. And the money, isn't that cool though? The money that we've made in the market is paying for the software that's going to track the money that we're going to make in the market. So all of the costs of development costs have been paid for this software that we're writing out of the markets, doing exactly what the software is going to track for us. So that's a pretty nice little feather in your cap. It's paid for by doing what it says it's going to do. All right. So, and then we got cash on hand. We got 24 grand. That's changed. That's not true, because I just went and bought. Let me see how much cash on hand I've got. I got to look over here on my other account. Hold on. I got 10,000. This is now 10,000. 10,000. 0.02, because I had 30,000 and I put 20,000 of it into Tesla right there. I put 14,000 on 6/18. When was that? That was yesterday. I put $14,614 of my dividends that I had received back into Tesla. Now, why did I do that? Well, if you go look at Tesla, I don't know if it's going to do that same thing. And this was a little concerning to me, but I don't know if it's going to do the same thing that Salesforce is. And that's one of the things that's concerning me, which is why I still have 10,000 sitting on the sideline. Because Salesforce looks like it wants to go up, right? I mean, this is a B. This is A down here. This is A1. This is a B1. So I wanted to see that go up, and it's not. It's fluffing out right here. It's looking to me like it might break down and go back down into a downtrend. And that would be if it breaks those blue lights, which it looks like it did yesterday, and because we didn't get a bar today, it didn't confirm it. But that looks like to me, if that breaks that blue lights, that's a B1 fail. And if that fails, that's not good. And I'm worried, looking at Tesla, that it might do the same thing. So let's get rid of everything we got drawn in. Well, let's not get rid of everything. Let's keep some of it because we just got to redraw it again. Oh, I want to keep that one. We'll get rid of all the arrows. Let's get rid of all the arrows. Get rid of this. Put our Fibonacci ruler back in there. And here I'm a little bit nervous. This is going to be B1 when it breaks those blue lights. Which if it breaks those blue lights, the B1, stop moving. The B1 would be back here, right? The valley before the blue lights. So we take our spider web, would be like that. So there's our first break, waiting for the B1 to break, and we're looking for that thing to rally up out of here and go into the B1 drive, which is why I put that money in there yesterday. Okay, I was like, okay, let's anticipate. We're right here at 38.2. I bought some at 61.8. Now I just bought shares there. I put a limit order, right? I put a limit order at 61.8, and I said if it comes down to 61.8, I'm going to buy, and it did. It came down there. It was like a Hail Mary shot. I just put that order in there at 61.8, and bam, that thing came right down to 61.8, filled my order. Now, of course, I put it just a penny or two inside. I don't ever put it right on the line. So I put it, I want it to come through my order, fill it, hit 61.8 and bounce. Because sometimes it comes down, hits 61.8, you got your order right at 61.8 and it doesn't fill it. So then that pisses you off. So I always put it just a little bit inside. If I want the order to be filled, I put it on the inside of my target zone. If I don't want the order to be filled, I'll put it on the outside of the target zone. All right. I never put it right on the target zone. So I put it either outside or inside. When would you not want your order to be filled? Well, if it's a stop order. If it's a stop order, I don't want the more order to come down, hit six. Usually it's going the other way, right? But let's say we're short. The market comes down, hits 61.8, and fills your order, stops you out, only to turn around and go back up. That pisses you off when that happens. So if I don't want the order to be filled, which is usually a stop order to get me out of the market, I'll put it just on the outside of resistance or support. And then if I do want it to be filled, I want the order to have to go through my order to get to the target zone, which is 61.8, because I want it to be filled. So I put it just on the inside. That way the market has to come down, go through my order, hit 61.8, fills my order, turns around and goes back up. And that's what it did here. And I'm up nicely right now on that order because I put in a bunch of money at 61.8. Now I'm concerned. I'm a little nervous that Tesla might pull a boner here and do a CRM and start to fluff back down again and go into a downtrend. But it is what it is, and it's in TSLY anyway, which I'm going to get my dividends off of. But I don't want to be buying into a down market in your yield max funds, because what does that do? That's why I always tell you never drip into a yield max fund. If the market's going down, just sit on the sidelines. Don't put any money more back in until you think it's going to turn and start to go back up, because otherwise it's going to compound your losses. If you keep putting money in, buying all the way down, and it just keeps going down and it's paying out those dividends, it's compounding your losses. So don't do that. If it starts to go down, just sit and wait. And then when it gets down there and you think, okay, we got a turnaround, we got a little head and shoulders bottom formation, we're getting a little ABC pattern, looks like it's done going down, we're going to go back up. That's where you want to start putting your money back in. All right. TSLY. So I got it in at TSLY. That's where I put it in yesterday, right here. So on this one, you can see we got one up for every down. There's our up, there's our down. Now I'm anticipating an up. I hope it doesn't just go up, break the blue lights, or even right here, just keep going down. If it just keeps going down, then I'll feel bad. But we're in the accumulation stage down in here. See that? So that's why I put it in, as I felt like. And then it doesn't pay its dividends until, if we look and see, dividends for it don't come out until, where's my Tesla right there. Dividends won't come out until like next month around the 20th. The 13th. I think it's scheduled for the 20th of next month. So it's not like I'm putting it in there to get the dividends. I put it in there as a timing, trying to time the market at that little dip as I'm anticipating it going into the B drive. So anyway, we'll see. But I'm a little under parity on this one, meaning that I was right at parity. So I put that $14,000 in, and that put me at 14,000 under parity. So, and remember that parity on this is full total infusion. It's not initial infusion. So that's why up here I have two numbers. I have my cash cow, which is going to happen in 6 months at this rate, because that was a weird month. May made me $53,000 in the month of May, but April was 30,000, March was 27, February was 26, January was 30. So that $50,000 month was really odd. That's an outlier. I don't generally make $50,000 in one month. Although I have, last December I made 65,000 in one month. So that's pretty cool. Sometimes those months happen. Why is this purple? I just made it purple because I was calculating what my taxes were going to be, and I figured that I have to, for my tax level, I was going to have 2 months of dividends to pay my taxes. So I said, okay, I work for the government for the first 2 months of the year on my dividends. So I'm going to have to pay about 30 plus, it's about $60,000 in taxes on this one account. Last year I had to write a stupid check to the government for over $200,000. But this account's I'm gonna have to pay the first 2 months, it looks like, from my calculations. Maybe the first 3 months. Depends. If I have some more of these, it'll be the first 3 months. But right now, I'm sitting at the first 2 months. So the first 2 months, I work for Sesame Street in Afghanistan. So that's what I'm paying for right there. Sesame Street in Afghanistan, because that's very important. Got to have that. All right. What else? So and then this gravy train, 16 months. Okay, this is months. So I'm sitting at 16.6 months. What does that mean? Well, that's total infusion. So that's blended money. So I start with 476, and then once I make 476, I'm not there yet. I'm at 275. Once I make 476, this will go to zero and become a green number. It's red now, meaning that I'm underwater and I've got to come up to green. So in 6 months at this rate, my full account should be cash cow. I should be up 476. This one here, gravy train, that one is full total infusion. So if I keep putting money back in, well, it'll keep pushing that gravy train total infusion out farther, right? So every time I reinvest, well, that number gets bigger because it has to cover that reinvestment. I have to make enough money to cover that reinvestment. And that's what gravy train is here. That's what these cash cow numbers are here. That's total infusion, not initial infusion. So 2843 shows you that on the YMAG, it's going to take me 28 months to cover my total infusion of $56. And I'm under parity right now by $1,000. But it looks like by July, they'll give me $1,000 and I'll be above parity. All right. And I'll start working towards cash cow. Well, as soon as you get parity 0, you're on cash cow. This would be, I'm going to change the label of that. That's going to be cash cow would be, so that would be when it's at parity is at 0. This would be gravy train. So how about we change that to gravy train? Because this is total infusion. So we'll just do that. Go copy, paste, paste, paste. We're going to put it up here. Paste, 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 paste. And that will help me separate it and know whether I'm doing total infusion or whether I'm doing initial investment. Now that means I got to change it on the UTU calculator too, the one for you guys, because that one actually has both, believe it or not. I have both. Let's go look and see. Let's close this one for now and open up the one I'm sharing with you guys, because it's a little different. So I'd put a Gravy Train in here. I put Gravy Train in here. So this is Gravy Train, Gravy Train. Oh, this in here is not Gravy Train. This is Cash Cow. Cash Cow. So it'll be a Cash Cow. This account will be a Cash Cow. It says in 15 months because we started with 155,000. Remember, we borrowed 50,000 from Grandma. Okay, so 155,000, and then total infusion because we put money back in is 170. It's not that much more. It's given us 41,000 in dividends. Our profit, total profit and loss is 21,000. We took 6,000 out and spent it. We got $1,000 in investments, and we've got Gravy Train is in 17 months. Cash Cow is in 15 months. So 15 months means that it's going to cover the 155, and then in 17 months at this rate, it should cover the total infusion of 170, which is the reinvestment. Now, when we come down here and look at these, this is called, again, that's Cash Cow. I don't think I'm gonna change this, not do it right now. I'll do it offline and then update this again. But this is, see, on this one, we have broke out the initial investment. So this is initial investment. So this is McDonald's money, the one that's in yellow. So you went out and you worked somewhere else. You brought that money in, you put it in here. This one here, this is money that you actually put in, reinvested. So you have profits. So because I have those separated out in here, we can do an initial Cash Cow and Gravy Train for each individual market. So for Misty, for example, we could calculate Cash Cow and we could calculate Gravy Train. So Gravy Train would be the total infusion. Cash Cow would just be the initial, how much we put in from McDonald's money. Does that make sense? Hopefully that makes sense. And that's that one. Okay. So this one here, we've got YMAG, Misty, NVIDIA, Tesla, and PLTY. We do have NVIDIA in this one. Do we? Oh yeah, we don't have much. Very little. Total so far, $892 is all we've made in 3 months. Where's NVIDIA? Right here. So we've only got 5,000. We put 5,000 in and we've received 3 dividends off of it. And we're $721 over parity on total infusion, which is only 5,000, which is initial infusion. So those are the same. We haven't got any reinvestments in here. This one, we got a reinvestment. So we could have a Cash Cow and a Gravy Train. I think that's a good way to calculate that. What do you think? All right. Hopefully you guys are following along with that little detour that we took. Let's come in here and look at PLTY. We already looked at PLTY, didn't we? No, we didn't. We were going to look at NVIDIA. So NVIDIA is the one that's we're looking for a break. It's a crazy market, and we've got some of that. We got it in our, how much did I say I had in my portfolio? NVIDIA. This is, let's see how much, do I have NVIDIA? I do. Oh, that's the old one. That's not the one I wanted. I wanted this one. Is this one mine? My UBI. Here we go. Okay, here's my real money account. So I have NVIDIA. I don't have very much. I only have 65,000 and I'm right at parity. So I'm expecting around on the 23rd, which will be next week, I'm expecting 4,000 or, well, that was 4,000. Look, I got 3,000 here, but usually it's around 2,000, 1,400, 1,300, but I added a little bit more in. So I'm right around 2,000. And then I got that weird one, 4,700. I don't think I'm going to get that again. I think it'll probably be closer to the 2,000 again, right? So I'll probably get around another 2,000. That'll take me way above parity. All right. And then these are just little charts that I put in here. These are called, what do they call them? Insert, they call them spark lines, all right, in Excel. They're called spark lines, and they're just little charts that go in one. Oh, you can't see it because I'm in the way. You can see this one. This is a spark line. So these little things right here, These are spark lines. And they tell you just a little one cell chart of what I've got it calculated to calculate this. All right, so it's telling you how big they are. So you can see the big spikes, that's this spike here. You can see this big spike, that's this spike here. Those are called spark lines. So you can put spark lines in your spreadsheets too. All right, so I still got 2 dividends to come in this month. How come I'm not getting a total there? That should be totaled. Sum that up this way, buddy. Okay, so I'm up 21,000 so far, and I've still got 2 more payments to come out. PLTY and NVDY, and I'm anticipating for PLTY to be $10,000 and for NVDY to be $2,000. So if we add another 10 and a 2, that would be 31, 30. So see, a little bit more than this one, but a lot less than this one. So maybe around the same as this one, April. So I'll make about $30,000 this month in my dividends. And that's not bad. I'm not going to complain about that. How would you like to make $30,000 a month? I think most of us would appreciate that. All right, there we go. So we're going to come in here and anticipate. Look at NVIDIA. It's got to break those blue lights. It will. You're like, no, it won't, Lan. It's not going to break them. Yes, it will. It could take off and go again, and the blue lights could still follow up, but it'll eventually break them. You never know when it's going to happen. But when it does, is it going to come all the way back down to 38.2? I don't know. NVIDIA is so strong. I don't know if it'll come all the way back down to 38.2. That's a long ways. That's why we have this other number in there, fib line 23. It may come down just to 23.6. It may not even come down to there. Some of these markets haven't even come down to there. And then other ones, of course, come all the way back down to here. Scare us. All right, PLTY. I got a lot of PLTY. You saw that too. What's my PLTY? I think this is my biggest holding right now. Palantir. I just been pouring money into Palantir. Remember, we talked about this because Palantir last month gave me $12,000. And I have, how much do I have in it? PLTY, total investment in Palantir. I've got total infusion is $141,000. So I put $141,000 in there. And last month alone, it gave me $12,000 in dividends off of that thing. That's crazy money. Look, I'm $40,000 above parity on that one. So I'm real happy about that. That means I need to put more money in there because that $40,000, we want to keep parity about 0, right? As long as we're in growth mode. So I'm $40,000 over parity. The reason I haven't got that back down and brought that money down is because it just keeps going up. I haven't got a place to put any money in. When was the last time I put money in? Let's pull it up again. When was the last time I put money in? June. Oh, I put in June. How many? I've only put one in June. I only put one. Now's June. In June this month, I've only put $20,000 more in there. So I must have put it in there right around in here somewhere. Probably right in here. I don't know where I put that 20 grand in. But I would have, knowing me, I'd have put it in right in here somewhere. Probably right where I put that little order for our account. I probably went and put 20 grand in right there. But that's that one. SMCI. That one we were anticipating a little bit better run, weren't we? We were looking at this one to come in here, and that didn't go anywhere that we expected. Send it back. Let's bring this down. It petered right out on us. It broke right there and just died. Didn't make us a 3-drive pattern at all. Came in with what we looked like we thought was going to be an A2 right there and just failed. Does that mean that we don't want a super micro? Well, it's making it. It broke. This is just ugly. I don't know if we want to be. It's breaking right now above that previous high. It looks like this is going to try and be I'm going to call this a fail. A2 fail. And we're going to come in here and we're going to call this one, we're going to look for this to be our B1. But it's such a weak market, I don't know if I want to recommend putting any money in that thing at all. Super micro. Is there a yield max super micro? Does anybody know? Look at the SPY. All right, this is the backbone of the market. Let's figure out what's going on in here. So right now, this is coming into a B1 right here. So B1, that's why we bought that second option right there. Right there. We got all these solds. They're going to, well, you never know. Could the market flop? Come all the way back down here and close? Could. If it does. If it doesn't, we're up 114, 82, and 60 on these. We're up good money on those. This looks like right here, B2. I don't want it to break those blue lights. That would show a tremendous amount of weakness. And that I do not want to see. No weakness right here, buddy. No weakness. Let's keep this baby rocking and rolling. Keep the Trump train going. All right, so that's our B1. A little bit of a pullback. That's a B2. Don't break the blue lights. No blue light breaking. Toast. Well, that's doing the same thing. Sell in May and go away. So we really don't expect June to be a lot. Or May. And it's proven out to be exactly what, historically speaking, this market's just died in the month of May and probably not going to do a whole lot in June. So just sit tight. Just realize that May, June, July, we don't start picking up till towards the end of August. August is oftentimes a little shitty too. Summertime, everybody's out barbecuing. They're not spending money on their, they're actually out spending money. They're not trying to save money. They're not trading. Not a lot of trading going on in the summer times. And that's what's going on here. All right. So just realize it's just, that's normal. That's normal. Sell in May and go away. Come back at the end of August. TRGP. So this is where, what we can do is we can sell a lot of premium in here, and because just dead markets are good for selling premium. Right. Let's look and see if 120. Oh, they don't have any volume on these things. They're a rotten little market. We got an option on there, like 0 volume. Well, that's today, 181. Targa. Well, we broke right there. This is such an ugly top. Is this A1 right here? A1. The low down in here. I don't know. We're going to call this B, though. Why don't you call that A right there, Lane? Why don't you call that a new rally? Because it's making higher lows on this little sideways thing. I don't know what that is. It's not anything. It's not anything. Sometimes there's just not anything. Let's call it A1 anyway. I don't know. It is ugly. That's all it is. It's just ugly. I don't know. X2SA1 right here. X3SA1. Is that what that is? X3SA1. You got this ugly little top in here. 1, 2, 3, 3, 4. I don't know. It's nothing. It's just a mess. It's hard to even think of it as being anything. Well, I don't know why the hell we're trading it. Tesla. Well, we talked about that one. I'm hoping that's a B1 right in there. It already hit 61.8. It should be the rally. If it wants to go down and hit 31.2, I wouldn't feel bad. But I don't want it to turn around and go back down. I want this thing to go up. Might be a little bit much to ask in the month of June for a rally out of Tesla. We might just have to sit on our hands. Tesla. We already talked about that one. All right, guys. I didn't get to put on any bull call spread because the market's closed, but at least we got a review. We got to review our UBI portfolios. We got to see where we had some errors in our math. We're going to fix those. I'm going to fix in this portfolio here, the one that I give out to you guys. I'm going to fix I've fixed the cash cow and the gravy train. Now I'm going to come down and I'm going to do gravy train and cash cow here too. So gravy train's in the right spot. I'm going to create a cash cow right here. Cash cow. And then the answer will go here. So we'll get cash cow. Let's make that left bold. And then right here, I'll calculate what the break even is for cash cow. Now that's going to be based on, oh wait, is this mine? Oh, this is mine. I can't do cash cow in mine because I don't know what the initial investment was. So that's not mine. Here, go ahead, save that. I'm back out of here. This one is yours. So this one, we do know the initial infusion. So we got cash cow here. Oh, so that is in the wrong spot. That's why in mine, it's not cash cow. So we're going to move cash cow over to this spot, and we're going to make this one is going to be gravy train. So cash cow, it becomes a cash cow when it breaks even, pays back the initial investment. And it becomes gravy train when it pays out the total infusion. Now, in this case, they're both the same. So this one has to go calculated off of that number, whereas this one will have to calculate off of this number. All right. So I'll make that change, and I'll update that on each one of these, and I'll post this out there on the spreadsheet, and we'll get that fixed. These are projects in the works, so that's just the way it is. It's not ever done. It's like software, it's just never done. As we figure out new stuff and the way we want to track things and how we want to track these funds, you just have to do it the way you do it. All right, guys, that's it. I got some fun things for us to look at just for fun here at the end, just to have a little fun. Let's check out Claire.
Hey, it's Claire. If you love trading tips with a side of sarcasm, hit that follow button and subscribe to Pitt News on Air at pittnews.com. I'll be here every week, unless I blow up my account again.
All right.
Hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pitt News Magazine. You can thank me later.
Baby Land.
Look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
All right, guys. We got Pitt News Magazine. And, of course...
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, and of course, if you do subscribe to Pitt News Magazine, that's where you get this spreadsheet that we work on. You get the spreadsheet for free. It's part of the subscription service for Pitt News Magazine. That's how you join the club. Join the club. Subscribe to Pitt News Magazine. Get all kinds of fun perks. All right, guys, that's all I got for you today. If you guys had fun, give me a little thumbs up. Let me know that we're on the right track. Even though it was a holiday, we didn't be able to do a whole lot, but we were able to review a few things, and hopefully you learned something, had a little fun. And we will catch you guys next Tuesday morning, and we'll do it all over again, all right? See where the markets are at and see what adjustments we need to make. We'll see if we can't put some bull call spreads on next Tuesday. We'll do that, all right? Okay, we'll see you.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.